Welcome everyone to the June NatWest monthly FX webinar. My name is Paul Robson. I look after G10 FX strategy for Europe for NatWest. As usual, I'm very pleased to say that I have Piers Leslie, the Chief Strategist and founder of Fact Not Fiction Forecasting. We'll be following the usual format for today's webinar. We'll be starting off with a run through of recent fundamental developments in global currency markets, particularly focusing on sterling against the dollar, sterling against the euro. That'll be my first sort of 10 minutes of the webinar. And then, as usual, I'll be handing over to Piers Leslie, who will be running through his take using technical analysis to shine the light on the outlook for major currency markets. In terms of the outlook for currencies, I think it's worth starting today's webinar just by being honest that major currencies have actually been relatively quiet despite the events in the Middle East, all of which would, I think, normally have seen bigger moves and volatility. So the lack of movement is a surprise. And I think one of the key takeaways for me when I think about the rest of the year is we must guard against being too complacent. That just because FX rates and markets have been relatively quiet, it doesn't mean that they're going to stay quiet for the whole of the year as economic developments come through and maybe technical levels break both to the upside to the downside that take us into different regimes. And I think that that's definitely important. In terms of our headline forecast and base case for the major exchange rates, they remain relatively unchanged since you last heard from the team a month ago. We still see sterling dollar moving higher, potentially up to 140 by the end of the year, euro dollar through 120, and a relatively flat outlook for sterling against the euro. That said, there's always risks around those forecasts, and recent developments make us a little bit more careful about looking for the dollar to weaken in the second half of the year. So we'll be taking a closer look at those projections over coming weeks, given the outlook for the dollar. It looks like it's a little bit more positive than we previously thought. Could I have the first slide, please? So I just wanted to spend a couple of minutes about reviewing one of those key themes I talked about, one being relatively quiet, stable, major FX markets, and sterling has participated in that. And I think for some people, it's quite a curious development because the events in the Middle East would tend to play to some of the vulnerabilities of the UK through current account, fiscal policy, politics, growth. And what we've seen in the past is that sterling has traded pretty poorly through those events. So the fact that the currency has held up relatively well, I think, is worth just spending a couple of moments in this month's webinar. So regular listeners and watchers will know that when we look at sterling, there's a couple of key drivers that we think tend to be important, and we spend a lot of time thinking about those. One is relative yields, the difference between the outlook for monetary policy in the euro area, the US, and in the UK. Central bank that's raising interest rates tend to be supportive of sterling. There's always risks, I think, around fiscal policy because government policy remains relatively close to the wind, and there's very little wiggle room. And when markets test the stability of the bond market that can see the currency do relatively poorly. Relative growth matters because the UK runs a current account deficit. It's important that the UK can attract money from abroad, and if growth is weak, it's just harder for that money to be attracted into the UK. And the one that's been pretty important over the last 6-7 years now is politics. Now, fiscal policy, relative growth, and politics all seem to be weighing on sterling, yet the currency has remained relatively supportive. One of those is because I think markets have looked for the Bank of England not to be cutting interest rates, but raising interest rates relative to the euro area and the US, although that's become more balanced of late. And then we must be left with other reasons for the resilience. If the usual drivers aren't causing the currency to weaken, then we must look elsewhere. And there's three that we've identified here at NatWest. The first one is central bank independence. If fiscal policy starts to be eroded, we're not expecting the Bank of England to flip from its quantitative tightening program to quantitative easing when they go from selling their assets, government bonds, to buying government bonds. International markets still seem to have confidence in the gilt market that if the sustainability of fiscal policy in the United Kingdom is stretched by the government, the gilt market will signal that they're uncomfortable with that, and that will ultimately change the path of policy. But I think it's the third one. I think it is some kind of safe haven throw from the Middle East that is coming back into the UK. UK has traditionally had strong links with the Middle East, and maybe markets and investors are just trying to diversify. Now, of those Middle East flows, if they are actually apparent, we don't expect those to persist. So through the year, we think that politics, fiscal policy, and relative growth will become more important. Can I have the next slide, please? This slide just highlights some of the risks around the outlook for that neutral outlook for sterling that we continue to have. So we do think we'll get bouts of volatility. Now, developments in the Middle East have continued to move forward, and at the time of recording, it looked like the Straits of Hormuz have been opened and a peace deal, but there's always a chance that that doesn't persist. But this chart shows from left to right the passage of time. So on the left-hand side, more immediate, is about the Middle East peace deal and whether that has an impact on markets. At the time of recording of this webinar, we were still waiting for the Makerfield by-election in the UK. Betting markets and polling strongly suggests that Andy Berman will win that by-election, but with everything, it's still a little bit uncertain. And local media and press have reported the likelihood that there could be a leadership challenge here in the United Kingdom in coming weeks. If that happens, I think that there will be a risk around party conference season at the beginning of the autumn, when we'll get a better idea of any shift in policy ahead of what we think might be an important autumn budget, where markets might start to think about fiscal rules, for example, spending and borrowing. About the same time, we still think we'll get a Bank of England rate increase here in the UK, just 25 basis points. Recent data have sort of ebbed and flowed around that, but we still think interest rates will be rising by the end of the year, maybe a little bit further at the beginning of next year. US politics continues to dominate. Towards the end of the year, we'll get the US midterms. I'm sure that will have an impact on the dollar and be important for sterling dollar. And throughout the whole of this, the focus will be on AI adoption and tech valuations. And again, that is something that could be a risk event for anyone with sterling exposure. I'm going to run through the rest of the charts a little bit more quickly, because I'm keen to pass over to Piers for his take on the outlook for currencies. So could I have the next slide, please? These two charts just are there to summarise the cyclical position of the UK. The economy continues to be relatively weak, but maybe not quite as weak as everyone had previously expected. The labour market is weakening. Today we had some revisions to the labour market data that are shown in this chart, so we didn't get the big fall in employment that was initially published, but it's clear that the labour market continues to tread water and the economy remains relatively weak. We do have higher inflation on the right-hand chart, and that shows the latest sort of energy price shock, but you can see that it's nowhere near as impactful as the energy price shock in Europe that was associated with Russia and Ukraine and sharply higher gas prices. And against this backdrop, the Bank of England is assessing the strength of the economy relative to the risks of second round effects in terms of inflation from that initial price shock. But we're not expecting it to be significant, and certainly the Bank of England remains cautious. They kept interest rates on hold for the day of recording of this webinar, but they're signalling that they want to see how price inflation develops before considering raising interest rates, and that's why we have that interest rate at the end or towards the end of the year. Next chart, please. This slide just shows market pricing, or how market pricing and our own view of interest rates have shifted. It's pretty fluid at the moment in terms following the economic data, but really the key takeaway from here is that markets at the beginning of the year expected interest rates to be coming down by about 50 basis points. They now expect them to rise anywhere between 35 and 50 basis points, depending on which snapshot you take. The NatWest forecast is for 1, perhaps 2, on balance, average 35 basis points of tightening by the end of the year. But we're not expecting anything nearly as dramatic as back in the initial or the 2020 energy price shock that saw bank rate go from near zero levels all the way up to 5% in a straight line. At the moment, the risks are perhaps skewed a little bit more to just 1 rather than, say, 3 rate hikes from the Bank of England over the next 12 months. Next slide, please. I just want to, just a couple of things about this slide. This is something that I think Piers will touch on, and in fact, this is a chart that I quite blatantly stole from Piers from his recent presentations, but it just shows that one of the key themes in global currency markets continues to be the testing of the multi-decade uptrend in the dollar. So you can see it's well defined. We're off about 15% off the highs. It feels like it has stalled, and we still think that's going to be the dominant driver of any upside in sterling dollar that we get for the rest of the year and into 2027. Next slide, please. And this is my final slide before turning the call over to Piers. So the two charts here, one shows our forecast for sterling dollar with reference to the average forecast of other forecasts across the street, along with the max and min range of forecasts. And the right-hand chart is exactly the same, just for sterling against the euro. For sterling dollar, you can see that our forecasts are to the top end of the consensus. Primarily, that is our weaker dollar view rather than a sort of optimistic view of sterling. We'll be reviewing that because being at the top end of the range, given recent developments in terms of Fed data in the Middle East. We just want to make sure that that's correct. So please look out for any updates over the next couple of weeks. You can see that some people still remain really quite negative on sterling. The consensus is for a relatively flat outlook for sterling dollar. In terms of sterling euro, you can see that we're a little bit above the average forecast. That's the purple line. The average is the yellow line. But I would also stress about how wide the range of forecasts is. So there is a lot of uncertainty. And at the bottom of the slide, I've just put a couple of risk events there that we have to be mindful when we try and guard against complacency in FX markets, because they've been relatively quiet. And so with that, I'd like to hand the call over to Piers.
Hi, thanks for that, Paul. Very interesting, all changing stuff. And interesting, as you say, that, there's been a lot of volatile events, but the currency seemed to have been very flatlining this year, just going sideways. It's an interesting month this month because it's June. So when we get to the end of this, it's the end of the second quarter. And that's important for the long-term picture, because one of the things a lot of people look at for the longer-term view are the quarterly charts. And so say I've got some quarterly charts, got some monthly charts. It's just interesting as we sort of we're over halfway through the month. We're nearly coming to we're in the second half of the month. So it's how these last few weeks of the month, how it pans out will be quite important, bigger picture for all these currencies. But if we can go to the first slide, please. So the first chart I'm going to look at is always the dollar index, because everything's traded against the dollar in FX markets. It's anything not traded against the dollar is called a cross when it comes to the trading. So it all depends what the dollar does, and that will pull everything else around. So it's important to know what's happening with the dollar index. It's like looking at the FTSE instead of just looking at individual stocks and shares. Gives you a glance what everyone thinks of the dollar as a whole, as opposed to looking at euro dollar or dollar yen or one of the other ones. So on this dollar index chart, this is the same chart we've been looking at for some time. So hopefully for those who've been on these calls before, it all sort of makes sense already. If you haven't, what we're looking at here is quarterly candles. It shows the rally since 2011 for the dollar. So there's two ways you look at a chart. The first is you're trying to find out a trend. Is there a trend? So since 2010, the dollar bulls would say, yeah, look, the uptrend's intact. Why is that? Because they have higher highs and higher lows, which means that each time the market makes a new high and comes back down, it rallies before the previous low. And the importance for that is it shows people are still in buying the dollar on the long-term picture. But now we've got a sort of conundrum, because the second point is you can draw a trend line. And we have the trend line underneath, which can be a quicker warning that the trend might break. But to get a break of the trend, you actually need to see a lower low. We've had a lower high if we look back at 25 compared to 22. But what's holding the dollar? What supported it last year? You can see those two large red candles. So I put a big red arrow in the chart, and you can see if you go back four or five candles, you will see two large red candles where the market collapsed back down. So everyone's very negative, the dollar. But what it did, it hit the long-term trend line. And now for 1, 2, 3, 4, 5 quarters, that's over a year, every time it's got down to that trend line, the buyers have come in and pushed it back up. So we want to see at the end of this quarter, how does that candle look? At the moment, it has a big spike on the bottom. So it shows this quarter that people are still interested in buying the dollar on the touch of the trend line. And the body, there is no real body. It's about closing where it opened. Now, can we see by the end of the quarter if that changes? Will it be red? Will it be going back down to test the trend line? Or will it stay up here testing what we call the resistance? So the trend line comes in around about 96, 80, 97 area. So the dollar index closes the month below that. That is where it starts to take away from this dollar strength that we've seen off the trend line. But it's only going sideways. There's been no strength since that large red candle, the last one. It's been contained between those two orange lines, which are about the 101, 102 area. Now, I've put them in that blue dashed circle to sort of highlight where they are. So what it is, it's the old highs from sort of 2015, 2016, and 2020. Price broke through it, so it switched back to support for 2023, 24. Then 25, it broke below it, so it switched back to support. Back to resistance. So if you want a stronger dollar, you need to see price above the 102. You could sort of say you need to get a clear close above 103 just to confirm that it's cleared that 102 area. And that's where the dollar would start to pick up strength. But at the moment, it's capped by that 101, 102 area. So that's the battle for the dollar bulls. We said for the dollar bears, it's that black line at the bottom. And when it's in a range, it's simply in a range. You can't sort of say, oh, it's broken out, or you have to wait for the break. So I'll look at that at the end of this month and see how the chart looks, and we'll look at that next month. So for the dollar, it's just sideways at the moment, but at the risk of breaking out, because the uptrend line is forcing the issue, because the uptrend line is pushing price up towards those orange lines. So soon price can go sideways and just break the trend line. So people have got to decide in the next couple of quarters, which way are we going to go? Are we actually going to take this higher, or is it just going to break down lower? So we go to the next slide, please. So now I'll come to sort of currencies that I know you trade more. So we'll start with sterling dollar. So this is the quarterly chart again. I've added on the Fibonacci extension. So what I do here is I take the initial rally from 2022 up into 2023. Then you had a pullback. So you had a big rally on sterling dollar. Then it pulled back from the where did it get up to? Got up to about 131 and pulled back to about 120. So then once we got the pullback and it starts to rally again, you can add on these pink lines. You project up the extensions. And if we look at these extension lines, you can see how helpful they've been. And quite quickly, very visually, you can see this. So the 61.8%, about the 138 area, that has held the quarterly chart. You've never managed to close above that. So you sort of got 4 attempts up to it and backed off it. But when it backs off it, does it come back down to? It comes back down to the 38.2%. So you can see for those sort of 4 quarters, it's used that 131.25 as support. So as Paul was saying, range-bound market, it's gone very sideways, not much has happened. But what has it done? It's just the buyers have come in at 131.25 and the sellers have come in at sort of the 138 area. So this is going to be key if one of those two break, because what it means is that one side's gone. So if it breaks and closes the quarter below 131.25, it would be negative. And just to make things a bit clearer, if we go to the next slide. Go back to that slide. Sorry, this is my fault. In a minute, I'm going to show something on another slide. So on this one, it's just that 131.25. And then you've got the 20-period moving average coming in underneath. So that would be your last sort of bastion of support. But I think a quarterly close below 131.25 would be negative. To get positive and think this sideways move has changed, you need to see price above 138, 139.60. It's like a 2-cent zone at the top. Above 139.60, that's where I think sterling dollar has got this move higher. If you get a monthly close above that. But if we go to the next slide, you'll see these levels sort of repeat. So I talked about the 131.25 there. So if we look at here, I'm looking at the retracements. Instead of the projections up, we just take the low. So we know the low in 2022. We know where the high was. I take the highest close. So the highest close came in about 137.71 on the monthly chart. And then we put the retracements on. So those are the orange ones. But I've also taken the shorter term retracements of the rally that beginning of 2025. You had a few months there where it shot up. And I've put the retracements of them, and they're in blue. Now, if we go to the next slide, this is the one I've zoomed in. Thank you. So this is the zoomed in. This is the end of that. So you can see where the orange lines, you know where they came from because of the previous slide. So what do we have here? We have that sideways price action, not much happening, but suddenly we know where the support should be. So the buyers have always been two places. One is the 38.2% at the 131.32 area. That's every move down there. By the end of a month, at the end of the quarter, it's rallied back up and pushed up higher. But here, I think that the problem is this quarterly or is this monthly? This is monthly, so I have to change at the top. So if you get down below 131.30, remember on the other chart it's 131.25, that just shows how significant it's going to be. It's going to be negative for the dollar, and you should see some, move lower, follow that in sterling dollar. You have an early warning system here of this, the 20 period moving average, 132.27. Remember I said to watch this at the end of the month? So in a couple of weeks' time, we have to watch where are we in relation to that 131.25, 132.25 zone, because below that would be bad news for sterling dollar if you want it higher. Below that opens up 129.50 and potentially 127.40 area. If we go to the next slide, please. You're going to look at sterling euro now. So sterling euro has been very good this year. It's good last year, actually, but it's been good again this year. So we've said all year long, watch just over this 116 area. It was a major retracement we spoke about in January. Now, if we look at it and look at the move down from the sort of 121 area we had last year down to the sort of 113 area, you can see that the 38.2% comes in at 116.54. We also had a level 116.06 that came in from the quarterly chart. So that's what's capping it at the moment. And if you look, for 5 months now, the high has been about 116.06. So that can't be a coincidence. And I think it's just people, they get to that level, they've made money selling it, and they're just going to sell it. It's a good technical level, and it comes off that 116 area. So if you want a stronger sterling euro, and you keep seeing it rallying up and think, oh, is this breaking? You need to see it above that 38.2% at the sort of 116.5. So you've got that 116, 116.5, that 50 cent sort of range. But while you're below that, the risk is price comes off again. So if price comes off, it's going to test that cloud again. So that cloud's held about 20 times every move down in sterling euro. So you don't want to see any move off that 116 area, get down below 114. So if you start to get a monthly close below 114, it's starting to think, well, what's happening here? The cloud's under pressure. And where you'd really get confirmation that sterling has lost its shine against the euro is if you got down below 112.65. So again, quite a nice sort of tight range, because even if you go to the wider range, you're looking at a 4 cent range, 112.65, 116.54. So that's the range you've got to look at. You can tighten it up. You can go look 114, 116, 2 cent range, and that's your early warning system. But the 4 cent is a better one for your long-term outlook. Now then, we'll go to the next slide, which you'll be pleased to hear is my last slide. So this is euro dollar monthly candle chart. So again, I look at the extensions going up because we had that rally up in 2022. And that took us up sort of to the 112.5 area. Then price fell back to 101.70 area. Then it rallied back up. So we can put on those extensions. So if we put the extensions on, you can see it stopped at the 100% extension, 119.19 area. We can then put the retracements of that last rally up. And you'll see that the retracements and the extensions come in at the same sort of levels. So it gives you double confidence that something should happen. And the first retracement was at 23.6, 115.08. And if you look at that for the last sort of 1, 2, 3, 4 months, 115 has been the lows. That's managed to hold it. But like at the moment, we're starting to test below that 115. So it's going to be crucial if the euro dollar bulls want to really protect this and keep this impulsive trend higher intact, you need to close the month and the quarter above 115. Below 115 starts to put pressure on the sort of 112.5, 113.5, which comes from the 20 period moving average from the Bollinger Bands, that pink line, and the 38.2%. So if you do get a test down there, that's going to be a real key battlefield for euro dollar. Where can we say, oh, euro dollar's fine, we've escaped this? You really want to see euro dollar above 118 again to feel like you've escaped the negative pressure coming back to test these support zones. And I think, the next slide, mustn't forget this slide. This is the disclaimer, which disclaims me from anything I've said. So it's a very useful slide. But I hope that's helped. Any questions you have, if you want to ask me anything, always contact your NatWest salesperson and they can get in contact with me. But after that, Paul, I'll hand it back to you.
Thanks very much, Piers. Super interesting as usual. It does feel, I think, the balance of risks will be about just watching those key levels to the downside, I think, for sterling that you've identified there, cable 131.25, and then sterling euro, if we go through 114, 112, 65, we've obviously got, as I mentioned at the beginning of the call, some risk events around sterling in terms of politics, fiscal policy, growth. But the US outlook will always be with us, and we've got the midterms. We've also got this equity rally as well, and continued focus on AI investment and adoption. It certainly dominates a lot of my conversation. So watching those, and as you say, Piers, watching where we end the quarter and what kind of impetus we have going into the second half of the year. I think that's all we've got time for this webinar. All that's left to say is thank you very much for joining and listening, and we hope to see you joining for our July update in a few weeks' time. Thank you very much.